Hello and welcome to this episode of Unvested Shares. In this video, I will be showing you how to fill out Form 8606, which is the IRS form that needs to be submitted when you do a backdoor Roth conversion. So again, when you do a backdoor Roth conversion, which I will briefly run over again as a review, you need to include Form 8606 when filing your tax return, and I'm going to show you how to fill that out in today's video. So as a brief reminder, a backdoor Roth conversion or backdoor Roth IRA is a strategy that is often used by high-earning individuals who cannot contribute outright to a Roth IRA because they make too much money, stated quite simply. In 2018, if you are a single filer and earn over $135,000, you can no longer contribute to a Roth IRA, or if you are a joint filer and as a unit you earn over $199,000, you cannot contribute to a Roth IRA. So again, the backdoor Roth conversion and the strategy there is you contribute up to $5,500 in earned income if you're under the age of 50 to a non-deductible IRA, and you then wait at least one period, one statement period, if not an entire year, before then converting that non-deductible IRA into a Roth account. And since you already paid your taxes before contributing to that non-deductible IRA, you won't owe any additional taxes when you convert to a Roth. So that is the high-level strategy of what a backdoor Roth conversion is. And a lot of times folks who are high earners will max out their 401k, and then on the side they'll also be contributing up to the $5,500 amount if they're under 50 years old, or $6,500 amount if they're over 50 years old, just to accumulate some additional retirement funds, but in a Roth vehicle, which essentially means it will not be taxable ever again. So once you have contributed into a non-qualified IRA, you need to essentially claim your basis to the IRS so they don't tax you on the amount. And so that's what this form is for. And this form is also, when we go into part 2, it talks about the Roth conversion, and if there's any taxes owed because your account appreciates, that will be highlighted there. So with further ado, let's go ahead and get started. And for this example, let's just assume that as a taxpayer in tax year 2017, as you can see, let's assume that I contributed $5,500 in March to the non-deductible IRA, and then let's assume that in December I am filling out this form just to make things, just to kind of be aligned with our assumptions here. So we'll start with line 1, which is enter your non-deductible contributions to the traditional IRA. And as we mentioned, I'm going to assume I contributed $5,500, let's say in March, okay? Let's assume then line 3 will flow through $5,500. And then if I did contribute anything after January 1st and before the tax close year, I could add that amount in here. So again, I'm assuming I contributed in March of 2017. Even if I contributed in March 2018, it would still apply towards my tax year of 2017. I would just put that $5,500 amount down here in line 4. But again, for this, I'm not going to. And so in line 5, I'll add in the $5,500, which is subtract line 4 from line 3. As you can see, that's obviously $5,500. So lines 6, 7, and 8, it's important to stop here because you'll notice that it says enter the value of all your traditional SEP and simple IRAs into line 6. And this is important because this is where the pro rata rule comes into play. And the pro rata rule essentially means that if you have any other traditional IRA, SEP IRA, or simple IRA accounts, you will have to pay taxes based off of a pro rata amount of your basis here plus how much funds you have in these other IRA accounts. So that is less than ideal, and that's not what we're going for here with the backdoor Roth conversion. So it's highly recommended that before you do a backdoor Roth conversion, you move all of your other traditional SEP or simple IRA dollar amounts and you roll those into a 401k if you have them. and it's not everyone can do it, and so you may have to use a pro rata rule. But ideally, you want to roll all of those IRA SEPs and simples into a 401k, so it's not applicable here, and that whole $5,500 basis is applied to minimize your tax liability when you convert it into a Roth account. So that's the pro rata rule. We'd like to avoid that. So in this case, I'm assuming that all my traditional SEP and simple IRAs, I rolled those into my employer 401k or my solo 401k or whatever it may be. Okay. And if you did have a pro rata rule, you would, as you can see, you would add in your traditional SEP and simple IRA amounts here, and then down at line 10, you'll see there's a multiplier, and that essentially multiplier would then determine your pro rata rule of how much additional taxes you would owe on your basis here. So we will flow down here into line 13 since we don't have to deal with this, which is essentially, this is the non-taxable portion of your distributions. Since this was all non-deductible or post-tax contribution to this IRA, our non-taxable portion of this distribution is the $5,500 that we contributed. In addition, in line 15C, our taxable amount will be 0 because the $5,500 matches up with our original contribution. Okay, so now we'll move down into part 2, and again, like I said when I opened up the video, I'm going to assume that I made this $5,500 non-deductible contribution to the IRA in March. And let's say that by the time I'm filling out this form 8606 in December, I had $100 of market appreciation. So the total amount that I am going to, convert into a Roth is going to be $5,600, right? The original $5,500 contribution, I had $100 of market appreciation, so I'm going to convert into a Roth the totality of that account, which is $5,600. But in line 17, it says enter the amount from line 11, otherwise enter your basis in the amount on line 16. Remember, our basis was only $5,500, so that's the original contribution amount, and so the difference, which is line 18, is $100, and this is the amount I'm going to have to pay taxes on. And this makes sense, right? Because I originally contributed $5,500 in post-tax dollars into a non-deductible IRA, so that's my original basis or starting point. That $5,500 grew to $5,600, so now that I'm converting it into a Roth, I have to pay taxes on that appreciation, which is this $100 amount in line 18. So we'll continue to flow down Form 8606 here, and then nothing here. We won't have to fill any of this out with this scenario and with these assumptions. Again, we'll go to 25C, the taxable amount. We'll put it in 0 here, and that is essentially it. So running through it real quick, again, I assumed I contributed $5,500 to a a non-deductible IRA in March of 2017. I had $100 of market participation and appreciation in my account, so it was worth $5,600 when I officially converted it to a Roth account, and therefore I owe taxes on the $100, which is in line 18. So that'll be my only tax bill, is I'll have to pay taxes on this $100 of appreciation. So that's it for this episode of Unvested Shares and how to fill out Form 8606. Hopefully it helped you out. If you have any questions or concerns, please leave some comments and I will get back to you as quickly as I can and as comprehensively as I can. Thank you.